Capital. Great to see you, Paul.
Thank you, Peter.
All right, so you haven't seen Harry's predictions, but I'm sure you've seen him in the past. And,
Absolutely.
You know, some people really believe he's right. It often takes a long time for him to be right, and sometimes he's helped by a thing called a pandemic as well. But you've studied the Australian property market because your business actually operates in it. What are the historical lessons that you've learned about Australian property prices and relate to what's going on now?
So, look, traditionally for property prices to fall suddenly or significantly, you need three items. You need unemployment to be high, you need higher interest rates, and you need a oversupply of property. So if you have those three elements, those are the three things that you look for as an alarm bell for property prices to fall. The last time we've had a property decrease, which was late 2017, it was a slight deviation from those three economic variables that we've had. So if we go back and have a think about what happened there, the economic data was actually pretty good. You know, we had official interest rates at 1.5%, and over the 3 years they were reduced. We had unemployment very low in the low fives, and we didn't really have an oversupply in property as well. So why did property prices then fall? You might ask yourself. Well, actually, it was an intervention done by the regulators. What we can actually say is that they've intervened, but we don't. The purpose of them intervening is that they could see the economy not at the level they wanted it to be. They wanted to drop interest rates, but they didn't want a bubble in the asset class.
All right, so the Reserve Bank was trying to improve the economy.
That's right.
But the housing market was overheating.
That's
so
right.
APRA got involved, and I remember they knocked the head on top of Chinese lending.
That's right, non-resident lending, they completely cut it.
Yeah, and investors have found it very hard to get money. And I know a lot of people I know had been given a yes from the bank, and all of a sudden when they got their investment property lined up, the answer was no.
And in certain markets at that particular point of time, you know, there was a lot of belief that the market was quite heated because investors participated in the market of about 45%. That over that 2-year period where those interventions started to happen, and interventions started to happen in 2015, it took a while for that to come through. So you had investors at 45% of the market, which was the highest ever. And the banks actually turned around and said, all right, well, if your interest rate was 3%, now it's 4%. So and by the way, we can't do interest only as well.
So they're worried about the proportion of investors in there.
That's right.
They want first home buyers and whatever. So, and also, I guess you throw in the mix the Bill Shorten effect as well, because Labor threatened negative gearing, didn't they?
So, and if you look at the taxation systems that we have in this country, it's very pro-property as well. So, having a incumbent government or a threat, potential incumbent government, taking away all of those benefits, and you know, leading up to that election, it sent a lot of negative sentiment. And so I think what is quite interesting in the 2017 is to say that sentiment also plays a very significant role in relation to where property prices will be.
Now nowadays we do have rising unemployment. There's a tick. But on the other two, we've got interest rates basically contained, probably Reserve Bank's implying at least 3 years of low interest rates. What's the situation with the supply of property?
Well, given the current environment as well, is that if you know, we were just looking at the raw data just actually this week. The amount of supply, new supply in the next 12 months to 24 months is a fraction to what we have been supplying in the last 2 years.
So if you looked at average supply of properties, the year going forward, it's going to be down significantly.
That's right. So we were delivering, depending which raw data that you look at, in Sydney, for example, you're delivering nearly 45,000 apartments in that particular year. If you look at the raw data given by one of the research analysts, which is Kramer Craig Charter, they're saying that in the next 12 months, we might be lucky to even deliver 15,000 apartments. So you're looking at a significant difference in supply.
So if Harry is going to be right, and both of us hope he's not, because it's a pretty scary scenario, you'd have to think that the pandemic effect on the economy is going to be such that unemployment might go over 10%, JobKeeper's basically taken away after March, and there's a serious high level of unemployment. I guess that means that there's going to be a lot of pressure for a vaccine to show up, because if that shows up, that takes away a lot of that threat to economic growth, doesn't it?
Well, I think you've mentioned two really important factors here.
Thanks very much, Paul.
The job keeper and job seeker, they're not just payments. They're also keeping the household cash flow intact, allowing people to pay their mortgages as well. But it's also a sentiment as well. I think people are confident with a particular sector, knowing that the government is doing, it's a once in 100-year event. It's not a very regular occurrence. So the fact that the government is prepared to have these measures to ensure that the cash flows are intact is very, very important. And you wouldn't see the leading indicators that we're seeing right now with people spending money, an increase of that. They're saying, well, you know what, the households are probably not doing as badly as what we think.
2 weeks in a row, the ANZ, Roy Morgan Consumer Confidence has had very big increases after falls that were linked to the Victoria close down. So I guess if we see Victoria eventually come out of lockdown and then get on top of their infections a bit like New South Wales, at least to that level, well then it's going to be a positive for the economy. But do you think that to avoid a Harry type scenario, we do need to see a vaccine so A, we can travel around Australia and eventually travel to other countries?
And I think the vaccine conversation that we've had in the last 2 or 3 weeks is quite positive, because people have an expectation that will happen at the end of the year or first quarter of next year, and things will get back to normal. And so it's very different to the last times that we've had property markets collapse, where you actually can see light at the end of the tunnel.
Okay. What are you seeing out there? Because your job, just explain to my viewers what Msquared Capital does.
That's right.
And tell us what are the most important things for you to feel as though the sector you work in is heading in the right direction.
So we're a private mortgage fund. So we connect opportunities of people needing money to investors who want to get a regular, safe return on their money as well. It's only secured by a first mortgage. That's very, very critical. The things that we're seeing in the market at the moment is that there's a significant need on both sides. There's a significant need of people needing to borrow money, because obviously even the banks have sitting on a lot of capital. They can't deploy it to certain situations, or they can't mobilise to deploy it quick enough as well. And investors in the current market, they're looking for a safe haven.
So the investor in this case is like a saver, really.
That's right.
And they're looking for term deposit type products, but they know you haven't got government guarantee. Also, they don't like the low interest rates on term deposits, so they're going up the risk curve, looking at you and other types of investment opportunities or saving opportunities. So you mentioned first mortgage. How is that relevant?
It's very, very relevant, especially in the current environment. When you're talking anything to do with debt, the first question you need to ask yourself, what is my security? So the security that we offer for our investors, they can choose the ones or the opportunities they want, or we take a first mortgage security. What
so
that
the
means
borrower has to put up a mortgage of
property.
But what if the mortgage is linked to some project that goes pear-shaped, or is that not the case with you guys?
Well, look, we are seeking opportunities for our investors, which are against completed property. First mortgage security only, and we don't lend more than 65%. And so just to take that down to a very simplistic situation is that if an asset is worth $1 million, it would have to fall more than 35% for our investor to lose their capital. Now that is a last case resort, because we seek borrowers who have cash flow to support the mortgage on the way through.
And you've explained to me before, like someone might come to you and say, look, I want $10 million for this business project. And you say, well, what are you putting up for
security?
And he says, well, I've got a property, a home worth $20 million.
That's right.
So that kind of person has something solid behind the borrowing.
And I think as we go along down this pandemic, what we're actually seeing is that a lot of people losing their money, thinking they understand what they're investing in. But like for example, the Virgin bond holders, I'm not sure if you saw the article today, the best case scenario, they're going to get 13 cents in their dollar. Now that was a business that borrowed $700 million last year, and it wasn't making any money. and people thought that they had security against a brand where there was no security. Now they're going to get the same returns with us, but we have a first mortgage security over a real asset. And that's really important.
Yeah. So I guess it would be to be completely brutal. You need a Great Depression, a real Great Depression, to come along to knock down the property values by more than 35%.
And look, from what we're seeing on a day-to-day basis, on the coalface, we are seeing the resilience of the property market quite strong. So, so far in Sydney, we've only seen officially on a data, it's only a 2% decrease. Now, that is nowhere near month-to-month change, what we saw in 2017, where it was a change in sentiment. And it was also a change, I can describe it as a credit squeeze. So if people want to borrow money to buy a property, and the bank is saying, sorry, we're not going to lend it to you, then that's what actually happened in that particular time frame. Whereas right now, the banks are more open to lend money to owner-occupiers and investors. We're not seeing the same
And you
thing.
said earlier that someone who provides their savings, they can pick and choose the projects they go into as well.
Yeah, it's very critical. So if you have a choice, and we give you two particular projects. One, it's geared at 50%, let's say in Bondi Junction. Another one is in, let's call any suburb in Sydney, call it Balmain, and that one's at 65%. And for yourself, you're saying, well, look, I'm more comfortable with a 50% LVR, lower return. That's my profile. And someone wants to go for a little bit higher return, higher gearing, you can choose that one for yourself. So we give that ability for investors to choose which transaction they feel most comfortable with.
Okay. Paul, thanks for joining us.
No problem. Thank you.